Have you ever found yourself thinking, okay, next time mortgages are just like super easy to get for anyone?
I'm definitely more careful.
Try exactly. Or maybe next time those internet companies with zero profits try selling IPOs at, billion-dollar valuations.
I am absolutely staying away. Yeah, it's such a common trap, isn't it?
It really is. We tend to fixate on those specific details, the unique things about the last market blow up.
And we convince ourselves, if I just avoid that specific thing, I'll be fine.
But what if that's, well, kind of missing the bigger picture entirely?
You've really hit on a key point there. Focusing on those particulars, it often blinds us to the deeper lessons, the ones that keep showing up.
Okay.
So today we're doing a deep dive into 5 of the most, well, devastating stock market crashes in U.S. history. We're drawing a lot from Scott Nation's book, A History of the United States in 5 Crashes.
Great book.
It is. And our goal here isn't to get lost in the weeds of, why this specific company failed or that specific rule existed.
Right. It's about pulling out the fundamental patterns, the things that tend to repeat.
Exactly. So you can leave this feeling genuinely forewarned and hopefully forearmed.
And that's what's so fascinating, isn't it? How these events, they're separated by decades, totally different technologies, different economic worlds.
Yeah, completely different contexts.
They actually share these surprising common threads. It's almost like markets just have this tendency to unravel when certain conditions line up.
Regardless of the specific spark.
Okay, let's get into it. Let's see if we can spot those patterns together. Where do we start?
Let's begin at the turn of the 20th century. The Panic of 1907.
Ah, okay. What was the setup for this one? I remember reading that it kicked off after some 1898 rule changes, right?
Yeah.
They allowed companies to actually own other companies.
That's right. And that led directly to the creation of these things called corporate trusts.
Giant holding companies, basically, like Standard Oil, Northern Securities.
Exactly.
Yeah.
And they quickly became this huge part of the stock market.
So, right there, maybe that's hint number 1. A new financial innovation taking hold.
Absolutely. These trusts, they were a really novel structure for the time. But then you had President Theodore Roosevelt.
Teddy Roosevelt.
Yeah, launching what some people called a witch hunt against them.
Yeah.
He saw them as monopolies, bad for free trade.
So he starts taking them to court.
And that kind of government action, that unpredictability,
Yeah.
well, it often creates market instability, doesn't it? Uncertainty.
Yeah, makes sense. But wasn't there something else, something totally unexpected that hit around then? The San Francisco earthquake, 1906?
Oh, yes. That had a huge kind of global ripple effect. Half of San Francisco's population, like 400,000 people, were suddenly homeless.
Wow.
And here's a wild detail. People usually had fire insurance, but almost nobody had earthquake insurance.
Okay.
So if your house was smashed up by the quake but hadn't caught fire, well, people would often just set it on fire themselves.
Wait, really? They'd burn their own damaged houses down?
To collect the fire insurance money. It sounds crazy, but that's what happened. Desperate times.
That's unbelievable. Okay, so how does that connect back to the market panic?
Well, a lot of the insurance companies were British, and Britain was on the gold standard back then.
Right.
So to pay out all these massive fire claims, the Bank of England had to ship out a lot of gold. To get that gold back into their vaults, they jacked up interest rates.
Okay, trying to attract gold back with higher returns.
Exactly, and this is where those corporate trusts come back in. Remember how they were kind of new and unregulated?
Yeah, compared to traditional banks.
Right, so they didn't have to hold as much collateral.
Yeah.
They could leverage their deposits way more.
Ah, so they could offer even higher interest rates than the Bank of England to attract customer money.
Precisely. So now you've got this environment of, unchecked leverage building up.
There's pattern number 2, maybe? Excessive leverage.
Seems like it. And you've got this global financial stress from the earthquake payouts and the rising British rates.
The stage was definitely set. So what was the actual spark? What finally tipped it over in 1907?
The immediate trigger, it came in October 1907. There was this failed attempt to manipulate the stock of a company called United Copper.
Okay.
The stock just cratered. And a bunch of banks and trusts had been using United Copper stock as collateral for loans.
Ouch. So they were suddenly in deep trouble.
Big trouble. People sensed the weakness, they panicked, started pulling their money out.
And you get widespread bank runs.
And that was it. The panic of 1907. The Dow Jones Industrial Average basically got cut in half, fell from about a 103 in early 1906 down to 53 by November 1907.
Wow, nearly 50%. But did it recover?
It did, and relatively quickly. By the end of 1909, it had regained almost all of that loss.
Interesting.
But here's something else to note, connecting to another potential pattern. The crash came after some huge rallies. The market was up 42% in 1904 and 38% in 1905.
Right. Big run-up, new innovation, leverage.
Yeah.
Okay. So 1907 was a wake-up call, obviously. Led to the creation of the Federal Reserve.
Yep, in 1913.
But, that didn't stop the next big one, did it?
Not even close.
Let's talk 1929, the big one. What went wrong this time, even with the Fed supposedly watching?
Well, the Fed was founded specifically because of 1907. Back then, private bankers like J.P. Morgan had to step in and be the lender of last resort.
Right, they basically bailed out the system themselves.
Exactly. So the Fed was created to take over that role, provide stability.
But then, something happened with interest rates.
Yeah. In 1924, the Fed lowered its discount rate, that's the rate banks borrow from the Fed, to a record low at the time, just 3%.
Okay, so money became incredibly cheap.
Super cheap. And that just poured fuel on the stock market fire. It made financing stock purchases really easy, and it made stocks look way more attractive than, say, boring old bonds.
Created a perfect environment for speculation.
Absolutely. And then compounding that, you had corporations and rich individuals getting into the lending game. They were disappointed with low bank rates.
So they started offering something called call money.
Exactly. Loans specifically for buying stocks on margin, basically, offering slightly better interest rates than banks.
So another new financial innovation, kind of.
You could argue that, yeah. And it massively increased the leverage available in the system.
And this is the roaring 20s, right? The market just went nuts.
Totally nuts. You had tons of these new investment trusts popping up. They were attracting swarms of new investors, many who, never owned a stock before.
I heard stories about brokers setting up shop on cruise ships, on golf courses.
It was apparently that intense, just taking orders anywhere. It sounds more like a party than sound investing.
Definitely. And these investment trusts, they weren't exactly playing it safe, were they? Leverage again.
Oh, huge leverage. Especially using that call money we mentioned. It was pretty common for them to be using 2 times more borrowed money than their actual equity.
Wow. Another clear case of excessive leverage just building and building.
So you've got the cheap money, these new investment vehicles bringing in naive money, tons of leverage. The pot was boiling. What finally blew the lid off?
This time the spark came from overseas, right? From London.
Yeah. A big-time investor over there, a guy named Clarence Haytree, was exposed as a massive fraud.
What did he do?
He'd been using fake stock certificates as collateral to trick banks into lending him huge sums of money.
Oof. Fake collateral.
And when that news broke, it just shattered confidence, not just in Britain, but in America, too. People started thinking, wait, if banks can be fooled like that, what's anything really worth?
Questioning the basic integrity of the market.
Exactly, the fundamental soundness. So the market starts to wobble.
And because everyone's so leveraged, margin calls.
Margin calls went out everywhere. Brokers demanded more cash. But with stocks falling and so much borrowed money, investors and those trusts just couldn't meet the calls.
So they were forced to sell? Liquidation?
Forced liquidation.
Yeah.
Selling begat more selling, and, the great crash began.
And the aftermath was just devastating. The Dow peaked at 381 in September 29.
And cratered to just 41 by July 1932. That's nearly a 90% drop, even lower than the 1907 bottom.
Incredible. And it took how long to recover?
The market didn't get back to its 1929 level until November 1954, 25 years, with a world war in between.
A whole generation, and again, those pre-crash rallies.
Yep, strong ones, 29% in 1927 and a massive 48% rally in 1928. Same pattern.
Okay, wow. Let's jump forward quite a bit now. From the Jazz Age to, the era of big hair and personal computers, 1987, Black Monday.
Ah, yes, Black Monday.
This time, the innovation was something called portfolio insurance, right? Sounded good on paper.
It did sound good in theory. The idea was you could sort of insure your portfolio against big drops, pay a small fee, stay invested, ride out the crash, enjoy the recovery.
So what was the catch? What was the flaw in this brilliant new idea?
Well, it worked okay maybe for one person on a small scale, but when everyone started using it, it had some critical flaws, big ones. One huge assumption was that stock prices always move smoothly, gradually, no sudden gaps down.
Which isn't always true, obviously.
Not at all. And the other, even bigger assumption was that there would always be enough buyers, enough liquidity to absorb the massive waves of selling the insurance models would trigger in a downturn.
So the models required selling, but who would be buying in a panic?
Exactly. Someone calculated that for just one big firm using this stuff, even a small market drop, like 3%, would trigger sell orders equivalent to an entire D's trading volume in S&P 500 futures.
Just for one firm. Yikes! So the potential selling pressure was enormous.
Potentially overwhelming. It was a ticking time bomb based on flawed assumptions about liquidity.
So that's the flawed innovation piece. What else was going on? Leverage, economic pressures.
Oh, yeah. The 80s were the era of the leveraged buyout, the LBO. Companies buying each other using massive amounts of debt.
Right, another form of excessive leverage juicing the market.
Definitely. And economically, the U.S. trade deficit was ballooning. It was like 8 times bigger in 86 than 81. That was weakening the dollar.
So the Fed stepped in.
The Fed started raising interest rates to try and prop up the dollar. But higher rates make stocks less attractive compared to bonds, especially after the big run-up the market had already had.
Okay, so you have this fragile setup with portfolio insurance, lots of corporate leverage, rising rates. What was the final trigger for Black Monday itself?
The immediate spark actually happened over the weekend, leading into Monday, October 19th, 1987. The U.S. attacked Iranian oil platforms in the Persian Gulf, retaliation for an earlier incident.
So people woke up Monday morning thinking the U.S. might be heading towards a wider conflict.
Yeah, there was definitely war fear in the air. And that uncertainty triggered an initial sell-off when markets opened.
And that initial dip, that was enough to set off the portfolio insurance models.
That was the key. That initial drop triggered the program selling from the portfolio insurance strategies.
And those sales pushed prices down further,
Which triggered more automated selling from other portfolio insurance programs.
creating this vicious, self-reinforcing downward spiral.
Exactly. The sell orders just overwhelmed the market's ability to absorb them. Liquidity vanished. And Black Monday happened.
The single worst day in U.S. stock market history, percentage-wise. The Dow dropped. What was it?
22.6% in one day. Just staggering. It went from a peak of 2722 in August 87 down to 1739 on that Monday.
But the recovery was faster this time, wasn't it?
Much faster than after 29. The market actually hit a new high just 2 years later, in August 1989.
And again, those pre-crash rallies.
Yep. Pattern holds,
Yep.
28% gain in 1985, 23% gain in 1986. Big run-up.
Innovation, leverage, big run-up, crash. Okay. Let's move into more recent and perhaps more painful memory for many listeners. 2008, the financial crisis.
Right. This one's complex, layers upon layers.
Where did it really start? What was the core innovation this time? Mortgage-backed securities.
Yeah, MBSs were central. The idea of pooling thousands of mortgages together and selling slices of that pool to investors.
Okay, diversification seems reasonable.
But the critical flaw, the real game changer, was that the companies originating the mortgages, the ones actually giving out the loans.
They just sold them off immediately into these pools.
Exactly. They had no skin in the game anymore. Once they sold the loan, it didn't matter to them if the borrower defaulted. The risk was entirely passed on.
That sounds like a recipe for lowering lending standards.
It absolutely was.
Yeah.
A huge moral hazard. And many of these MBSs were packed with subprime mortgages.
Loans to people with poor credit history, often in the middle of a massive housing bubble.
And there was this political push for wider home ownership, which led to really lax standards, like 0% down payments becoming common in the early 2000s.
So more people could buy houses, pushing prices even higher.
Right. But investors weren't super keen on buying the riskiest slices of these MBS pools, the ones filled with the dodgiest subprime loans.
Understandable. So what was the solution? Another innovation?
Another innovation, or perhaps complication, collateralized debt obligations, or CDOs.
Okay, what were those?
The basic idea, and this turned out to be disastrously wrong, was financial alchemy. If you took enough of these risky, crappy subprime mortgage slices and bundled them together.
Diversification would magically make the bundle safe.
That was the pitch. Pile enough risky things together and presto, it becomes safe. It defied logic, but it sold.
Wow. And then there were CDSs, credit default swaps.
Yep. Think of those as insurance policies between financial institutions on these MBSs and CDOs. If one defaulted, the insurer paid out.
So that just tied everyone together, didn't it? Made the whole system incredibly interconnected.
Totally interconnected. And it allowed leverage to build up even more, because if you had insurance via a CDS, you didn't need to worry as much, right? Or so the thinking went. More leverage.
And didn't the rating agencies play a role here? Moody's, S&P?
A huge and frankly terrible role. They slapped AAA ratings, the absolute highest, safest rating possible, on vast quantities of these securities backed by incredibly risky subprime mortgages.
How could they do that?
Well, their models were flawed. There were conflicts of interest. But the result was catastrophic. And AAA rating meant institutions needed less capital reserves against these things, allowing them to borrow even more.
So the whole global financial system basically became this giant leveraged bet on U.S. house prices never going down.
That's a pretty good summary, yeah. Concentrated risk, hidden by complexity and faulty ratings.
And then house prices started to fall.
They did. And the trigger, the Lehman Brothers moment, came on September 15, 2008, when the investment bank Lehman Brothers declared bankruptcy.
And because everyone was so interconnected through those CDOs and CDSs?
Lehman going down triggered panic. No one knew who was exposed to whom, who was solvent. Credit markets froze. It was a system-wide meltdown.
The Dow fell hard again, from over 14,000 in October 2007.
Down to about 6,500 by March 2009, over a 50% drop.
Were there big rallies beforehand this time?
There were decent rallies, 16% in 2006, but 14% leading up to the top in 2007, but not quite as explosive as before the other crashes. Still significant gains, though.
Okay, one more. The flash crash of 2010. This one felt different, faster, weirder.
It was definitely different. Very short-lived compared to the others, but shocking in its speed.
It had something to do with Greece initially.
Yeah, there was a backdrop of sovereign debt fears, particularly around Greece. They'd kind of fudged their way into the Eurozone, went on a borrowing spree, and by early 2010, default looked possible.
And there were protests, riots in Greece around IMF loans.
Exactly. Austerity measures were imposed, leading to significant unrest. That created some nervousness in global markets.
But the crash itself wasn't really about Greece, was it? It was about algorithms.
Primarily, yes. Unlike 1987, where humans ultimately pulled the trigger based on models, this was largely computers gone wild. The main culprit algorithm was actually using a similar strategy to 1987's portfolio insurance dynamic hedging.
So selling automatically to limit losses, but this time fully automated. That was the innovation. High-frequency algorithmic trading at scale.
You could definitely call it that. It had become a huge part of the market by 2010.
Okay, so what set it off on May 6th, 2010?
Those riots in Greece caused an initial dip in the market. In response, a large mutual fund firm, Waddell & Reed, decided to hedge its massive portfolio against further losses.
Okay, seems prudent.
But they used an automated trading algorithm provided by Barclays to execute the hedge. And crucially, because they were maybe in a rush, they told the algorithm to execute the sell order based primarily on trading volume, not price.
Wait, sell regardless of price, just get the volume done.
Essentially, yes. They didn't put strict price limits on it. The algorithm was designed to sell a certain percentage of the volume being traded at any given moment.
Uh-oh. I can see where this is going.
Right. So as the algorithm started selling, it increased the trading volume, which told the algorithm, oh, look, lots of liquidity, I can sell even faster.
So it accelerated its own selling into a falling market?
Precisely. It created this terrifying feedback loop. Its own selling activity made it sell even more aggressively. Liquidity just vanished as other algorithms pulled back, seeing the crazy price drops.
It was basically leveraging a false signal of liquidity.
You could say that. It was just blindly following its volume instruction into the abyss.
And the market just plunged. How far did the Dow fall?
Intraday, it dropped 9.2%, down to 98.69. But the really bizarre thing was what happened to individual stocks.
Yeah, I remember hearing about this. Crazy prices.
Truly stupid levels, as Nations puts it. Prices no human would ever rationally trade at. We're talking about stocks like Accenture trading for a penny, Apple briefly traded near $28, Coca-Cola near $4 for an instant.
Just glitches in the matrix caused by the algorithm?
Glitches caused by runaway selling, hitting zero liquidity. Over 3 million shares reportedly traded at prices 90% or more below their previous day's close.
Wild. And this one is the exception to the pre-crash rally rule, right?
That's right. No major two-year run-up here, which really highlights how powerful those other factors, the flawed innovation and the way leverage was applied by the algorithm, can be on their own.
Okay, so we've walked through 5 really different, really damaging crashes. 1907, 1929, 1987, 2008, and the 2010 flash crash. Now, let's try and tie it all together. We've hinted at patterns, but what are the clear common threads you see binding these events?
Well, looking back and connecting it to Nations analysis, 3 things really stand out almost every time.
Okay, lay them on us.
First, every single one of these major crashes involved the introduction and sort of widespread adoption of some new financial innovation.
Right, we saw that. Corporate trusts in 1907.
Call money and investment trusts in 29.
Portfolio insurance in 87.
Those complex MBSs, CDOs, CDSs in 2008.
And the high-speed trading algorithms in 2010? Okay, That one seems solid. What's number two?
Excessive leverage. It's almost always there, often linked to that new innovation.
Yeah, the trusts in 1907 could borrow more.
The investment trusts in the 20s were loaded with debt.
Leveraged buyouts fueled the 80s.
The AAA ratings on subprime junk allowed insane borrowing in the 2000s.
And even the 2010 algorithm was, in effect, leveraging its trades without price limits based on volume. Seems we just keep finding new ways to borrow too much.
It really does seem to be a recurring human, or maybe market, tendency. Maximize those returns, often by borrowing.
Okay, innovation, leverage. What's the third thread?
This one's striking. Strong stock market returns in the 2 years leading up to the crash.
Right, we mentioned those huge percentage gains before '07, 2987, and even solid double-digit gains before '08.
Exactly. Big run-ups seem to precede the big fall-downs. The only real exception we discussed was the 2010 flash crash.
Which, as you said, maybe just shows how potent the other two factors, innovation and leverage, can be, even without a massive preceding rally.
Could be. It emphasizes their importance.
So what's the big takeaway here? If these patterns keep repeating, what does it mean for us, for you listening?
I think it means that while the specific catalyst for the next crash is anyone's guess, it could be anything, a geopolitical event, a corporate fraud, who knows?
Right, it's always something different, often unexpected.
Exactly. But these underlying conditions, new financial innovations being rolled out, leverage building up somewhere in the system, often after a period of strong returns, these things create the tendency, they set the stage.
So the market doesn't fall apart just because of the catalyst, but because these underlying conditions made it fragile and ready to fall.
That's the idea. The innovation provides the new mechanism, the leverage provides the amplification, and the prior returns maybe create the complacency.
It really makes you wonder, doesn't it, this cycle? Innovation, leverage, crisis, eventual rebound. What does it tell us about us? About human behavior, our appetite for risk?
It's fascinating. Is it about short memories? Or is it just the nature of markets? It's constant push and pull between innovation, greed, fear, and ultimately resilience, because they do bounce back.
And maybe that's the most crucial lesson of all, the one Scott Nations really hammers home in the book. Despite the pain, despite the fear,
The market always rebounds, always has so far. It might take time, sometimes a painfully long time, like after 1929.
but history suggests that great rewards eventually come to those who can, somehow, stay the course, stay invested for that later upswing.
It takes foresight and definitely fortitude.
So maybe the final thought to leave you with is this. Knowing this pattern of innovation, leverage, crisis, and rebound, what does it make you think about? About how you view financial history, or maybe about what might be brewing out there right now? What's the next innovation? Where's the leverage building today? Something to ponder.